If you think the winners in AI will only be the companies building this, then you may already be looking in the wrong direction. Computing power itself isn't a real bottleneck. What actually limits AI systems is how data moves between chips, servers, and racks. In today's video, we're breaking down a company that doesn't build the flashiest processors, but sits at one of the most critical positions inside AI infrastructure. Hey everyone, this is Stock Market Breakdown. Today we're only talking about Marvell Technology. It's not the most talked about AI company in the market, but almost every high-performance AI data center depends on its technology in some way. I'm not here to talk about short-term price moves or make predictions. I want to focus on one thing: whether Marvell's role inside AI infrastructure is being fundamentally undervalued by the market. Let's start by getting the positioning right. Marvell doesn't do the computing. It handles the movement, while NVIDIA and AMD are performing calculations. Marvell's chips are responsible for moving data efficiently between chips, servers, switches, and storage systems, high-speed Ethernet, PCIe, storage controllers, and custom ASICs determine whether computing power can actually be utilized. You can't think of Marvell as the nervous system of the data center if the nervous system isn't functioning properly. Even the most powerful compute hardware gets choked by system bottlenecks, and performance never reaches its theoretical potential. This is exactly why Marvell is so often underestimated. It doesn't sell the most eye-catching chips, but it operates in one of the most overlooked and hardest to replace positions in the stack. As AI systems become more complex and scale larger, the demands on connectivity, power efficiency, and stability increase. The process actually amplifies Marvell's value rather than pushing it to the sidelines. From a business structure perspective, the company has already undergone a meaningful shift. In the most recent quarter, Marvell's revenue grew nearly 37% year-over-year, exceeding $2 billion for the quarter. Roughly $1.05 billion of that came from the data center segment, accounting for more than 70% of total revenue. That shows the company is now deeply tied to AI and cloud infrastructure, rather than legacy communication cycles. More importantly, profitability improved at the same time. Marvell moved from significant losses to solid profitability, with gross margins above 50% and operating cash flow exceeding $500 million. This isn't a sentiment bounce, it's a change in operating quality. So the real question isn't whether Marvell has an AI narrative. The question is whether it can consistently convert these less visible, but absolutely critical technology advantages into scalable, repeatable profitability. That's what determines whether Marvell becomes a true long-term infrastructure company, rather than just a temporary beneficiary of an AI cycle. Now let's look at the core product drivers. Marvell is pushing system-level improvements in power delivery and connectivity efficiency. Its new package integrated voltage regulation solutions shorten the power delivery path, significantly reducing energy loss, while supporting much higher power density compute platforms on the interconnect side. Whether it's PCIe 6.0, retimers, or longer-term transitions toward optical connectivity, the goal is the same: allow computing power to scale without system bottlenecks becoming the limiting factor. This matters because the central challenge in AI data centers has changed. It's no longer just about whether systems can compute fast enough, it's about whether they can run stably, efficiently, and at scale. The problems Marvell is addressing sit directly on that critical path. Strategically, Marvell is also expanding its footprint through acquisitions in optical interconnect technology. The company is positioning itself early for the transition from copper to optical links as AI clusters continue to scale. Bandwidth, latency, and power consumption become hard constraints. Optical interconnects only grow more important in that environment. Management has indicated that these technologies could contribute billions of dollars in annualized revenue over the long term, effectively placing a long-term bet on next-generation AI architectures. Of course, this path isn't risk-free. Marvell's revenue is highly concentrated among a small number of large customers, Any design changes, in-house development efforts, or shifts in capital spending can have an immediate impact on results. The concentration risk is a major reason the market has been reluctant to assign a more aggressive valuation. Competition is also very real. Companies like Broadcom are strong players in custom silicon and connectivity. Hyperscalers are increasingly developing their own solutions by positioning itself at the core of AI infrastructure. Marvell takes on more execution complexity. If execution slips, its advantages can erode quickly, but if execution remains solid, the long-term payoff can be significant. That's why the stock's behavior looks the way it does. Fundamentals are improving, but the market is still watching closely. A short-term bounce doesn't mean the company has been fully repriced. It suggests the market is reevaluating the business rather than delivering a final verdict. From a market perspective, Marvell stock has started to recover after a substantial pullback. Analyst sentiment has turned more positive, with price targets well above current levels, but this doesn't mean certainty has arrived. It means that as long as AI data center investment continues and Marvell increases its value contribution per system, there is room for valuation expansion over time. In the end, Marvell isn't a company betting on a single breakout product. It's betting on the long-term complexity of AI infrastructure. It solves problems that become more important the further AI scales, not the ones that get the most attention early on. Whether this becomes a true long-term opportunity depends on three things: sustained demand, disciplined execution, and the ability to manage customer concentration risk. This is Stock Market Breakdown. I'll see you next time.